In order to reach the goal of reaching our financial freedom, we're often told to save at least 20% of our net income. But the question is that truly enough to cover everything we would need? So for this, I've actually made a few notes that I'm going to be referencing as I go along in this video. So let's assume that you make $55,000 per year. This is your gross income, and you'd get taxed as a single person around $9,485. Well, that means you will have left about $45,000 as your net income. We're going to then say that we divide this number by 12, we have about $3,700. And we're just going to round it up because it's slightly above $3,700. We'll make it about $3,800. According to financial experts, they always say that we should save at least 20% of our net income. So I'm guessing you're probably familiar with the 50, 30, and 20% rule of saving, which means that we should use 50% on just the essentials, we should use 30% on the discretionary spending, and we should use 20% on saving. Most of the time, they always say that we should save at least this 20% in maybe a 401k or maybe in a Roth IRA. Obviously, this is a good thing because you let this money work for you passively over time, especially if you choose good funds to invest this money in. But this is not a video for that. Let's continue with the savings. Before we go on, I want you to please strike that like button, and also if you haven't subscribed to the channel, please consider subscribing to the channel by hitting the subscribe button below. So using this 50, 30, 20 rule on a $3,800 income, that means that we should use around $1,900 on the essentials and use $1,140 on discretionary spending and use around $760 for the savings. Now, obviously, this savings can be split up in maybe a 401k and a Roth IRA. So using this online calculator, we're going to assume that you have $1,000 in cash to start investing for your retirement or for the future. And that means that your $760 from your income will be invested over time every month into this account for the next 30 years at a return rate of around 6%. So after running this calculation, this comes out to be $746,373, which is not bad on a $760 investment every month for 30 years. The interest earned will be around $471,773. So to an average person looking forward, this is not a bad type of deal, because remember, you're making about $470,000 on interest, assuming you start right away and you invest that money for 30 years. But here's something that is often missing when we are considering the savings for the future. We got to remember that when we're saving for other things as well. We need to save for, probably you got to save for your wedding, you got to save for a house, you got to save for your child if you have a child, or you probably have to save to pay off debt as well. For example, your student loan debt. So the question is saving 20% really enough to cover all of this aspect of life? So to answer this question, the problem isn't the percentage of money being saved, it's actually the amount of money being made. So we're going to make a different scenario here. We're going to assume that you have doubled your income and you're making around $120,000 per year, and your taxes comes out to be around $30,000. Your take-home pay comes down to be around $90,000, which means if we divide this $90,000 by 12, we would get around $7,500. Using the same 50, 30, 20 rule for budgeting, $3,750 for essentials, and we're going to have $2,250 for discretionary spending, and we would have about $1,500 for savings. So if we invested this $1,500 per month for the next 30 years, at a 6% return rate, that means we would have about $1,467,512, and the interest earned will be around $926,512, and that is a good thing. And you can see the difference between someone making $55,000 saving 20% of their income. The interest earned was $471,773 compared to someone that made $1,500 savings making $120,000 per year, earned around $926,000 in interest. Now, this is where it gets interesting, because the person making $120,000 per year is able to afford more money towards discretionary spending after contributing 20% towards income and 50% towards essentials. The discretionary spending is around $2,250, which means that this person has more options in terms of where to spend their money. And if this person does the right thing with this discretionary spending, that means they can choose to save at least half of that money and still keep up with a decent lifestyle. So if we divided $2,250 in two, then we would have around $1,125 to be saved to meet other life necessities, like buying a car in the future, like buying a house in the future. And this person can choose to save this money for as long as possible. Remember, this is the money that is being saved every month, which means that at the end of the year, this person would have saved around $13,500 without any earned interest. This is exactly why it is very important to consider earning more rather than trying to increase the rate of saving. Now, there's nothing wrong in increasing the percentage of saving, but the problem is that when you make a certain amount of money, you are very limited in terms of your options. And to be honest, you still got to survive and pay rent and have a decent lifestyle. So I hope you found value in this video, and I hope that you've gained some knowledge in this video. If you have, please give it a thumbs up, and also don't forget to subscribe to the channel. I'll see you in the next one.